We have already looked at how inflation can be caused by demand-side pressures or cost-side pressures. This video is going to look at the consequences of inflation. Now, for a great many years, until quite recently, inflation became the main target of governments in order to try and maintain stability with the economy. It was felt that if governments could and central banks could maintain a low but positive rate of inflation, then that would be the best objective to seek in terms of stabilising the economy. More recently, there's been a bit of a movement away from this. Some people are talking more about focusing on other aspects of the economy, maybe economic growth directly and so on. But certainly, it remains the case that in the UK at least, the only specific numerical target relating to the economy is the inflation target of 2%, and that is a mandate which has been given to the Bank of England, and they are allowed 1 percentage point of deviation either side of it. So somewhere between 1% and 3%, and that was felt to be the ideal situation. So this video is going to go through what might happen if inflation were substantially higher than that, or much more volatile than that, and then I'll do another brief video on what the risks are of inflation which comes in persistently below that rate. So, what are the negative consequences of inflation then? Well, there are several of them, really. One of the main ones that I think needs to be addressed, first of all, is the aspect of uncertainty. And this relates to volatility in the rate of inflation. So this isn't necessarily about saying that inflation is very high, but if it is unpredictable, then that can cause problems in the economy, mainly in terms of business investment. So if there is a high level of volatility in the rate of inflation, then businesses might feel uncertain about the future and their future returns and the future prices and so on. And as a result of that, they may rein back on business investment now, which would obviously reduce the level of aggregate demand. Another major impact is on the standard of living. Real wages, essentially real incomes, because remember, this idea of real incomes means taking account of the rate of inflation. So as the rate of inflation goes up, your real income will actually fall if your monetary, your nominal income doesn't rise, because your income will now be capable of buying less. So for instance, just today, the train ticket price increase has taken effect. So average train ticket prices in the UK are going up by 2.3%. If your income doesn't go up by 2.3%, then actually those train tickets now appear relatively more expensive to you. They now take up a greater proportion of your income. So that means that that your standard of living will be hit. When that happens across the board, that can be a negative consequence of inflation. Another important one that we need to think about is the impact on international competitiveness. Now, I'm sure you will already have looked at or thought about the impact of the exchange rate and how the exchange rate can affect prices between different economies. Well, inflation obviously is changes in prices as well. So if one economy has a substantially higher rate of inflation than another, then it will appear that the exports of that country, the one with the higher rate of inflation, are becoming expensive more rapidly to potential consumers abroad. So international competitiveness may be harmed because exports increase price relative to domestic product. So what that means is that for a consumer abroad, the imported products now are appearing to increase in price faster than domestic ones, so they're likely to buy less of them. Getting into slightly more technical ones now, we've got what we call inflationary noise, and this is very much due to the fact that free market economists at least would argue that that an economy functions by the price mechanism, and the price mechanism sending signals through the economy about what should be produced and the rationing effects and so on. If you've got high levels of inflation, then those signals become distorted. It becomes difficult to see which of those changes are actually due to changes in demand and supply, and which of those changes are due to changes in inflation. So inflationary noise can mask price signals, and it could be argued that that would lead to inefficiency of resource allocation within the economy. Another risk is that we may enter an inflationary spiral, which means that the higher prices then feed through and workers start demanding higher wages, and that those higher wages then impact the firms, who then increase their prices again to compensate, and so on and so on. So there's a danger as well with inflation that that we may enter an inflationary spiral. So just a couple more to go then. What we've got then, and again this is a slightly technical one, are reduced or potentially negative real interest rates. So interest rates is obviously the return that you earn on saved money, on the cost of borrowing money. If the inflation is higher than the rate of interest, then the real interest rate would actually be negative. And that would obviously be very detrimental to those people who rely on savings income in order to fund their standard of living. So pensioners would be an obvious example there. So when inflation outstrips the interest rate, then we have negative real interest rates. And the final one that we can think about is that inflation has a redistribution effect. It's often suggested that inflation is regressive because it affects prices. It means that people who spend a greater proportion of their income are more affected by inflation than those who don't, than those who save, for instance. So what that means is that that generally lower income earners, who tend to spend a higher proportion of their income, they will be much more negatively affected by inflation than higher earners do. So next slide, we'll just have a quick look at some evaluation that you can use to think about the relative size of these impacts on individuals within the economy. So when we're thinking about inflation, then I suppose what we can think about is we can think about it in terms of winners and in terms of losers. So the winners from inflation, there are going to be some, so don't always get into the idea that inflation is bad for everyone. If you've borrowed money, then you are going to benefit from higher levels of inflation, because it means that the repayments that you make, which are fixed in monetary terms, will become smaller in real terms. So if I've taken out a loan and my repayments are £100 a month, let's say, and the rate of inflation is very high, then so long as my wages are also rising, then that £100 actually starts to become a smaller proportion of my income. So the real effect there is that actually borrowers will benefit. Producers can also benefit from this. That's if the prices rise faster than costs. So what that often means in effect is if prices are rising faster than wages. For most businesses, wages are quite a substantial element of their costs. So if prices are rising faster than wages, then producers will benefit. It's also possible that some workers may benefit if they have a strong bargaining position. So that often means if they're a member of a union or something like that, then they can benefit from inflation because they will be able to use it essentially to demand wage increases, at least in line with inflation and potentially higher. So who loses then as a result of higher levels of inflation? Well, most of these you can just flip around. So if you are a lender, then you are damaged by inflation. I suppose kind of similar to that is if you are a saver, particularly if you rely on those savings for income, then that can be very damaging, because the income that you generate from it is going to fall in real terms. Workers, especially the low paid, without kind of substantial union representation and so on, because they are unlikely to be able to negotiate wage increases of a sufficiently high magnitude to keep up with inflation. Exporters are likely to be harmed, as we've said. We saw that high levels of inflation in one country can be damaging to the export chances of a business, because their products appear to increase in price faster. So the first thing to think about in terms of your evaluation is that there are winners and there are losers, and we also need to think about some general evaluation points. Firstly, you always need to think about the magnitude of inflation. So if inflation goes up from 1% to 1.2%, yes, it's an increase in inflation, but it's not of a high enough magnitude to cause many of these serious problems that we've seen already. Another important one to think about is the duration of it. So the longer that the high inflation or the inflation volatility remains, the more substantial the effects will become. We also need to think about the cause of inflation. Remember, we said that inflation can be demand pull or cost push. So we need to think about what has caused those various types of inflation to occur. Most people would argue that demand pull inflation is less serious on the grounds that it reflects a general strengthening in the economy. So it's likely that wages and so on will be rising at the same time. Cost side inflation, though, particularly imported cost inflation, tends to be regarded as being more negative. So when we think about the inflation, those are a number of ways that we can think about to evaluate its impact on an economy and on individuals within the economy.